All right. Good afternoon, and thank you so much for joining us today for the release of Filling the Hole, a two-part report from the Ohio River Valley Institute describing the need for bold policy action to ensure that the industry, rather than the public, pays for the growing cost of decommissioning the region's hundreds of thousands of unplugged oil and gas wells. My name is Ben Hunkler, and I'm the communications manager with the Ohio River Valley Institute. Our organization is a nonpartisan regional research institute working to chart a course toward clean energy, shared prosperity, and more equitable civic structures. You can learn more about our work on our website at www.ohiorivervalleyinstitute.org. We're very pleased to be joined today by report authors Dwayne Purvis, founder and principal advisor of Purvis Energy Advisors, and Ted Bettner, who's a senior researcher at the Ohio River Valley Institute. In just a few moments, Ted and Dwayne will share key findings from their research on Appalachia's legacy well problem and policy solutions to ensure timely industry-funded cleanup. We're also thrilled to be joined today by Megan Milliken-Bivin, who is an expert on abandoned well policy and the founder of True Transition, an organization dedicated to American energy produced by American energy workers for the benefit of American communities. Megan will join us after our presentations to share a bit about the Abandoned Well Act, model legislation that she introduced in 2021 to advance cleanup of the nation's millions of abandoned wells. In the meantime, I want to make sure to mention that this webinar is being recorded and that closed captions should be available at the bottom of your screen. We will take questions at the end of today's program. Please feel free to add those to the chat or to the Zoom Q&A box, and we will get to those in the order that they're received. We will send around a recording of today's presentations after the show, and we invite you to check out the full report on our website. I will drop a link to that report in the chat in just a moment. And in the meantime, Ted, I will turn it over to you.
Awesome. Thanks so much, Ben, and appreciate everybody being here. And what I'd like to do over the next 10 minutes, try to keep me within that time frame, is to provide sort of a brief overview of the reports about looking at some of the central problems facing states in Appalachia that have significant gas production and also have a large inventory of orphaned and abandoned wells. I'll also try to paint a national picture. And when I finish, the lead author of the report, Dwayne Purvis, will take a deep dive into some of the central findings of the report, and we can both answer questions that you may have. So to get it started, as folks probably already know, the Ohio River Valley region of Appalachia has a long history of oil and gas development, dating back to the mid-1800s during the country's first oil boom. But it wasn't until about the mid-20th century that states began regulating the industry, including permits and well plugging enforcement. Unfortunately, that legacy persists today with the regulations that have failed to ensure the proper decommissioning of these assets. The goal has not only been hundreds of thousands of unplugged orphaned and abandoned wells, but little enforcement and weak compliance with state rules on plugging and abandonment. And this includes ultra-low bonding coverage that doesn't incentivize operators to plug wells. Also, culture of non-compliance within the industry, inadequate staffing of agencies, and also the political will to hold operators accountable for decommissioning. As you can see in the slide that's up, there are about 265,000 unplugged non-shale oil and gas wells in Ohio, Pennsylvania, and West Virginia. And Dwayne will get more into the details of these. But we look at the plugging that's occurred over the last several years to see that on average, private operators are plugging just a small fraction of the total wells that exist in the states. Interesting too, in the case of Ohio and West Virginia, the public is actually plugging more wells than private operators, as you can see in the chart there. At current pace, looking at the total inventory of unplugged non-shale gas wells in the state, it would take close to 300 years to decommission today's unplugged non-shale wells in Ohio, Pennsylvania, and West Virginia. So it's pretty obvious looking at this data too that the status quo is not working, or it's going to take hundreds of years in order to properly close these wells at the rate today. The next slide, Ben. And we're also seeing problems with failure to plug shale wells. This data here is from the Pennsylvania Department of Environmental Protection, and it looks at violations for failure to plug abandoned shale gas wells in Pennsylvania. These are the unconventional horizontal wells, high producing wells that are there. As you can see, there have been about 400 violations for failure to plug over the last 15 years, and it includes about 69 in 2024. And looking at the data a little further, you'll find out that about 50 of the wells that have had violations are neither plugged nor producing today. So there's a problem where they're not exactly active, not plugged, not producing, and just in abeyance. So that's a real problem with the compliance issue here today we'll talk about. Next slide. In the report, we estimate total liability for documented unplugged shale and non-shale wells at about $38 billion. And that is based on decommissioning costs provided by state agencies and also several large shale producers in the region. To put this in perspective, the bonding coverage in these three states, Ohio, West Virginia, and Pennsylvania, is only about $115 million. So that's less than 1%, about 0.3% of the total cost. There are many things that can drive the cost of plugging. We're happy to talk about that too. But those change depending on the rate of inflation that Dwayne will get into that as well later. Looking nationally, the report estimates that the total onshore cost of liability in all of the states of the country is about $271 billion. And that's for onshore unplugged wells in the whole country. So needless to say, this is just a huge problem when you're looking at it nationally or you're looking at it in the Ohio River Valley. The good news is that fixing the problem offers many benefits for operators, the public, and our economy. So the next slide is just looking at the Ohio River Valley states of Ohio, Pennsylvania, and West Virginia, which feature in the report. And we estimate that over 20 years, we could create nearly 7,000 direct jobs cleaning up just the unplugged documented shale and non-shale wells in the region. And if you look at the current level, how many jobs create, this would be almost a third of the total jobs that are in the upstream gas, oil and gas industry in the three states. Dwayne will talk about this in more detail. And what I'd like to do now is sort of shift over to Dwayne and let him get into the details of this. I'm just trying to provide sort of an overview. So I'd like to pass it on to Dwayne and just, Dwayne has about 30 years of experience in the oil and gas industry. He's a registered professional petroleum engineer where he has worked with oil and gas operators, governments, banks, law firms, and NGOs to navigate the challenging energy landscape. He's also founder and principal advisor of Purvis Energy Advisors, which is based in Fort Worth, Texas. Dwayne is also one of the leading experts on oil and gas well decommissioning in the world. He's worked closely with professional organizations, governments, and other stakeholders on how to make the best engineering and strategic decisions with the legacy of these assets. I've had the pleasure with Dwayne over the last couple of minutes, and I've learned more than I ever thought I would about geology, oil and gas operations, and the important role that insightful analysis can play in developing sound policy. So with that, I'd like to pass it on to Dwayne. Dwayne, get over.
Yeah, thank you so much for that, Ted, and thanks for working with me on this report. And what I'm going to do is, as you said, kind of rewind back to the beginning and build up to those key points that you already highlighted. So when we bore a hole through eons of solid rock, we are creating a pathway where that oil and gas can come to the surface. When we're done, there is no natural process that will seal off those pathways in Appalachia. So we're relying for the future of mankind on the plugs that we put in those wells to prevent unwanted flow. Now, the conventional, or should say non-shale reservoirs, by the time we finish producing, the pressure in the reservoir is substantially depleted. It's still higher than atmospheric. But in a shale reservoir, when we're done producing, it's substantially depleted only close to the wellbore. And over the life of the plug, the reservoir at the location of the wellbore will repressurize. So what we do know that plugged wells do at some point risk failure. They can fail. And we know that a lot of wells in the early history of the industry were plugged to different standards, contemporaneous standards, but not the standards we have today. So when the tri-states area, the three key states of Appalachia, are considering the future of their population of wells, they need to consider three sets of wells, three categories for planning purposes. And this map shows two of them. In red, we see wells that have already been drilled as horizontal shale wells since 2005. And those existing wells are broken down in gray by the state that they're located in, and they represent a great deal of future production. The black dots represent unplugged non-shale wells. You can see that there are about 14 times as many non-shale wells, but there are about 24 times as much proved producing reserves in the shale. So we have this massive discrepancy, and the much larger part of the industry is the non-shale. Now, all of these need to be plugged in the future, but there are also legacy wells of two kinds that may breach in the future and may become orphan wells in need of repair. The less likely to leak are the about 200,000 wells that were plugged in recent times, documented to have been plugged and plugged to probably modern standards. But of course, as Ted said, the industry predates good record keeping by about a century. So we don't know exactly how many undocumented, unidentified wells there are. We do have indications of how many wells were drilled. It's just not concrete enough to narrow it down. Again, here the numbers are broken down by state. In West Virginia and Ohio show proportionally much less than Pennsylvania. It appears that there's a different methodology at play there, so the numbers could be higher. But in total, the three states are going to be responsible in perpetuity for somewhere between about 600,000 and 1.2 million oil and gas wells, or they'll be post to that many. Now, there will be some drilling that continues, but the future drilling of shale wells in particular is likely to be less than the number of wells already drilled to date, partly because the wells are getting longer and more productive, and partly because we have already drilled so many. This graph emphasizes the disparity between the two. Broken up by state, the purple line represents historical production of shale wells, and those represent a substantial decommissioning liability of about $6.5 billion. Now, to come up with these estimates, we've looked to two places. For decommissioning costs of non-shale wells, we have looked at the historical cost of orphan well plugging programs in the three states. And we find that those have increased significantly in recent years, but they converged around $120,000 per well. To estimate the cost of decommissioning shale wells, we have reverse engineered public disclosures by two major Appalachian producers. There's more uncertainty on that number. 6.5 billion is the center of the range. And that represents 300 some odd thousand dollars per well, substantially more. Now, the orange line represents non-shale wells. And those are the much larger liability, $31.8 billion, we estimate. So if we include future drilling, then in the tri-state area, the non-shale wells represent 2% of proved reserves, but 83% of the liability. Now, that would not be such a problem if the same companies owned the shale wells and the non-shale wells. If the same companies owned both, then the profits from high producing shale wells could be used to pay for the decommissioning of low producing non-shale. But that's mostly not the case. The ownership strategy is separate. There's one group of companies that drill and another that focus on depleting, that use different strategies in their different portfolios, and the assets of the one are not available to cover the liabilities of the other. So let's look at the non-shale wells and their own internal capacity to fund their own decommissioning. These three bars show the three states, 100% of the non-shale wells in the three states, color-coded by the rate at which they produced in the last full calendar year. For reference, a well that produces less than 90 MCF per day, 90,000 cubic feet per day, is called a stripper well because that has historically been deemed a well that's marginally economic. On these graphs, the blue represents the wells in these three states that are not stripper wells. And the gray represents wells that are producing less than 10 MCF per day on a value equivalence basis. In total, only 0.2% of the wells, non-shale wells, unplugged, are producing at non-stripper rates. The average rate is less than 5 MCF a day, and the average age is more than 40 years, which means these are very old, very low producing wells. If they're going to cover their own decommissioning, they've got to come up with about $120,000 each by our estimate. That, assuming no decline in production, it would take, and assuming that all of the money, all the profit from operating went to paying for decommissioning instead of going to the owners, it would take decades to accumulate enough money to pay for those costs. That, of course, is not practical. The bonds that are in place to cover all forms of wells in the three states represent only 0.3% of the current liability, so that's not a help. As Ted said, the private companies are plugging some wells. At the current pace, it would take 299 years. Longer in some states, shorter in others. But in two of the three states already, the plugging with public money is greater and faster than the plugging with private money. And as the Pennsylvania Department of Environmental Protection has said, there is a culture of non-compliance. What this means is that at this point, $31.8 billion, more or less, of decommissioning liability at today's cost for non-shale wells are very likely to fall on the public sooner or later. And of course, the shale wells, as Ted said, are continuing to decline, reaching their life, and without a change in policy, those are likely to end up in the same position. So a marginal change, or even a significant change, in such an utterly unhelpful policy structure is unlikely to create the public good that we should be looking for. So let's rewind, look at first principles. There are three basic ideas here. Either the industry pays, or the public pays the money to decommission, or the public pays the cost of not plugging the wells. Of course, on the ideal scenario, it's the current operator that bears that cost. And in the worst case scenario, it would be the public. And up to this point, what has been plugged has been borne mostly by owners. And the orphan well programs in most states have been funded by other oil companies. It was only in the last few years that federal taxpayers began to step in to fill the gap. But looking forward, a lot of these options just don't exist. There's just not enough money there. So what it comes down to is if the work is going to be performed, then the taxpayers are going to pay for it, or the money will come from other oil and gas companies. Of course, that is the historical principle. That is the first principle of polluter pays. And in many cases, the companies that are now shale producers historically have been producers, owners of the non-shale wells. This calculation shows order of magnitude what it would take. So if we look at all the shale assets, including the proved undrilled volumes, and we compare that to the total shale non-liability, and we put a margin on it. We say, not only are we going to raise enough money from the shale wells to cover 100% of the non-shale wells, we're going to give it a 25% margin. Even in that scenario, the cost of the fee to oil and gas producers is only 21 cents an MCF. Or if you're talking about $3 gas, which is probably on the low side of what people expect, is 5.4%. By comparison, Texas, with really significant production, has a severance tax on gas of 7.5%. And perhaps more interesting, the EIA last year estimated that LNG exports will drive up the price of natural gas for Americans by between 54 cents and $1.04. So in this area, the cost to provide a generous budget for decommissioning all the old non-shale wells is between 20 and 40% as much as the cost that will be created by LNG exports. Those aren't quite comparable, but it's a good frame of reference. So if we're going to collect $32 billion from future production, then the question is, where does the money go? And the obvious answer is, well, not back to the oil companies, but also people are not real keen to give it to a government agency. And so the solution is a government-sponsored entity that has independence to run the work. Now this idea was first created by Megan Milliken Bivens, who's here, thank you, from True Transition. She calls it the Abandoned Well Corporation. And it took me years to come around to this idea because it is such a radical idea. But the conclusion I've come to is that there's just not a better choice. Now, the Abandoned Well Corporation would be a government-sponsored entity, and then other functions for capacity building could be handled within Abandoned Well Corporation or alternatively as a government agency called the Abandoned Well Authority. But for future reference, and please don't try to read these now, you can see the functions that we're talking about. It would be an independent third party, not with its own board, rather like the Resolution Trust Corporation or maybe like the post office. It would be the receiver for bankrupt companies. It would operate the wells and be responsible for them, and also for their decommissioning. If wells are plugged by an operator or by the Abandoned Well Corporation according to their own standards, then that entity can retain the long-term liability to handle wells that are breached in the future and found to be leaking. And of course, whether in the Abandoned Well Corporation or the Abandoned Well Authority, some centralized agency can function for capacity building. It can be a central repository for best practices and best information to make it possible to do everything, to empower the operators that are going to handle their own decommissioning. Now, not surprising that when reforms have been proposed in other jurisdictions in the past, there has been pushback from industry. The costs have not historically been borne, they've not been planned for, and they've not been paid for. They have been accumulated in other jurisdictions like they have been in the 3 states we're looking at. And the objections run like this. You'll drive some companies out of business. You will harm local economies. You'll decrease local secure supply of gas, and you'll increase the cost to Americans. But the direction is not magnitude. And what Ted and I have done is to look at these kinds of dynamics with 8 or 10 separate analyses, some of our own and some from literature, but looked at it a bunch of different ways. And what we found is that it doesn't have nearly the impact that you might be afraid of. In fact, it's probably trivial. So this is just one simple, quick example. This is a slide taken from EQT Investor Presentation in 2018. It's a little bit old, but it's one that's most clear. Along the x-axis are 4 different scenarios for how they're going to develop the play, and the lines represent different prices for natural gas. Right now, the price for natural gas in Henry Hub is above $3. Differential is probably more, but they're headed this direction. And what you see is that they were projecting 120 to 140% rate of return for their drilling investments, which is extraordinary. There's a long history of slides like this, investment theses like these. Now, bear in mind that an oil company is going to make a drill, no drill decision at a rate of return that's closer to 10%, or maybe in recent times people are using a little higher. But the rates of return are so far above the rate required to make the investment that an incremental cost does not push drilling decisions off the table. That is, they can make the same decision whether they're making 120% rate of return or 110% rate of return. In total, what we found is that the loss of production from small producers is in fact small. We found that the impact on drilling is minute, especially in Appalachia. That in the process of increased accountability, examples in other jurisdictions demonstrate that we can expect lower or fewer orphan wells in the long run and fewer environmental citations. And as Ted said, the process of doing the work creates significant employment. But what's more, the plan that we've outlined, besides that one major key fee and authority, includes other steps of mitigation. We can, if it is possible, to exempt low producers from the fee, in which case it has zero effect on the economic limit and the supply of gas from those producers. But we've also proposed an amnesty program. Now this would be something relatively limited, and to be clear, it's a bailout. But it'd be relatively limited for only small private producers who would be required to surrender their wells. But instead of just losing their jobs, they become temporary contractors to the Abandoned Well Authority so that they maintain some continuity of employment and the opportunity to become full-time employees. But in the short term, they continue managing the same wells that they managed before the surrender. So the total picture of the reforms that are necessary, as we recommend, look like this. Again, there's a good deal of detail here for future reference, but first, new and recent wells should save now. There's no better time than at the beginning when the cash flows are high. So you have a full escrow of new and perhaps recent wells. That escrow, the money continues to belong to the oil company, and it can earn interest, and it can be redirected to investments to support local oil field communities. But wells that are more depleted, they're farther along in their life, can continue as is, no change, except that there's increased accountability. We would require prompt plugging, no longer accumulating, require full assurance at transfer, and require that wells, that operators get caught up within a fixed period of time. They have to clean their balance sheet and get caught up on their idle wells. They can choose how fast, they can put money in escrow instead of doing the work, but they have to be back in balance within a small number of years. If they can't do that, then they end up going bankrupt. And as I said, that's not necessarily a bad thing, because the end result is the wells are operated by better companies. But if an operator thinks, if some operators, the small operators, think that they can't survive continued operations, well, then they have the option for an amnesty program. A short time period when they could surrender their wells and become contractors in the short term. But it requires a number of different mechanisms that are separate and distinct because of the disparity between the condition of the wells and the operators. One policy, one simple policy, isn't going to do it. And as we've seen in other states like Colorado, how you write the details is at least as important as what you write. Because it's possible to have, in theory, transfer liability or full bonding at transfer, but also possible to leave such a loophole that it makes little difference. In the case of California, for example, California intended to require full bonding when ownership of wells changed. But when CRC bought ERA, they structured it as a stock transaction rather than an asset transaction, and effectively avoided the full bonding that had been expected. But it's also important that the work be done sooner rather than later. The longer we wait, the worse the problem is. The longer we wait, the more costly it is, the more liability, and the more that liability is concentrated on a smaller volume of future production. As a last note, second to last note, these three states are in relatively good position because they do have shale production. If the shale had not come, if the Marcellus and Utica had not come to Pennsylvania, Ohio, and West Virginia, they would have been unable completely to fund the decommissioning. But of the 36 significant states in the Union with oil and gas wells, only 11 have meaningful shale production. 25 of them have only old non-shale production. And states like California cannot be expected to raise enough money inside the state from the producers inside the state to pay for the decommissioning of the wells inside the state. So it is possible and even preferable to normalize the standards, to level the playing field across the states, and to pay for decommissioning of wells in all of the states with a national deployment of the AWA instead of a state-by-state deployment. The back of the envelope calculation says this is about $3 and about 20 cents an MCF. $3 a barrel and 20 cents an MCF in order to fund all of the plugging of all of the wells in the country. That's only an order of magnitude kind of number, but what it shows is it is viable. And in the process, we do more good for the local economy. So across the board, across the industry, in oil and gas, employment, research and development, membership in professional societies, they're all down about half since 2015. That's not unique to the three states. This graph shows BLS statistics over the three states, and it shows very close to half of the jobs in oil and gas, our direct employment, upstream oil and gas, are gone in the last 10 years. Now, during that time period, production continued to increase, reached an all-time high, and held it. But employment's down by half. If we were to assemble the money from the excess profits or from the profits and dividends of oil and gas companies and directed it to meeting the long-standing obligation of decommissioning for the public good, we would also create employment. Now, how much you create depends on how fast you do the work and how much it costs in the end, and some economic analysis on how many jobs are created per million spent. Based on DOEI numbers, we're looking at a significant increase in employment. And what's more, that employment is steady rather than cycling up and down as you see in the history with drilling. And the economic activity of decommissioning is almost certainly very much larger than the economic activity of remaining production. So we have every reason to do the work, and if we don't do it now, it's only going to get more difficult. So thank you for listening. Then let me hand it back to you.
Thanks so much for the presentation, Dwayne. Again, please feel free to drop questions for Dwayne and Ted, either in the chat or in the Q&A box at the bottom of your screen. And in the meantime, we'd like to invite Megan to share a bit about her work on the Abandoned Well Act.
There we go. Hello, good morning, everyone. My name is Megan Bivin. Great presentations, gentlemen. That was stellar stuff. Thank you for everyone for coming today and hearing yet again about orphan wells. It's still an issue. It's still a problem, and we're hoping to solve it. And just to give a little background on how I came to the issue, it's a story that both of these gentlemen know well and why I came to this particular solution. I used to work for the federal government, particularly the Department of Interior, where our orphaned wells in the Gulf can be, for one company, $2 billion to deal with. And right now, the federal government is actually overseeing an orphan well program through the bipartisan infrastructure bill. The Department of Interior Bureau of Safety and Environmental Enforcement is plugging wells and removing platforms off the coast of Texas as we speak. And so we are doing this already. It's really just a matter of recognizing that if we want to make any progress on the national level, we're going to have to build the apparatus and the government infrastructure to do this at scale. And as Dwayne mentioned, there is not an inevitability, but there will be a percentage of wells that will indeed fail. And it's an acknowledgement that if we are not monitoring these wells on some kind of coherent schedule with, a trained workforce, that we're going to miss this and we're going to have accidents. And we're going to ruin aquifers, and we're going to have houses blow up like they did in Firestone, California, or upstate New York. These things have happened and they will continue to happen. And so the Abandoned Well Administration was my attempt to try to corral all of these issues into one coherent whole. And so I'm excited that I ground you down, Dwayne, and you're like, it's the worst possible thing, but I guess we have to do this. And I hope I can persuade everyone similarly that you too will stare into the void and accept the inevitability of some kind of government agency form like this. So thank you for giving me a minute to speak, and y'all should avail yourselves of the expertise of these gentlemen and ask them some questions.
Thank you, Megan. We've got a quick question from Amy Townsend Small in the chat about the proportion of wells in the US that are owned by small companies.
The purport, the, I don't know what the number is nationally, but I can tell you in certain jurisdictions where I've looked that the large majority of companies are indeed small, fewer than 10 or 20 wells. But the large majority of wells are in large companies, either large companies that drill or large companies with 400, 4,000 wells that are focused on late life, mature production. So the percentage of wells that are owned by small companies nationally is probably on the order of 5 to 10%. Yeah.
I would just add too, EDF has done some breakdown of stripper well ownership by size of operator. In Appalachia too, you have to remember there's a lot of wells owned by individuals as well, families. So depending on what size you mean, well size, is that how, or employment size. But we did do a breakdown in our report, which I'll put in the chat, on Staying Alive, which looked at stripper well ownership. So you can look at there. But as far as that, this is like Dwayne said, I've never seen a national breakdown of those well ownership. But what we need, I think the biggest point Dwayne made earlier too, is that when you look at the liability versus the production, that's a huge disparity between the two. And that's one of the reasons we're at the problem we're at today.
Yeah. Well, and let me add one thing, because I have done this. There are about 2 million documented wells that are unplugged. And half of those are standing idle. And about 350,000 of them are producing less than 1 barrel a day. The fact that the US has the highest production of any country ever in the history of the world is concentrated in a very small number of wells. 93% of the production of BOV, I should say, comes from 7% of the wells. And the flip is true. About 93% of the unplugged wells contribute like 7% of production. Very, very highly skewed.
So we've got a question in the chat from Karen who asks about quality control and enforcement. Could you elaborate a bit on how those concerns will be addressed in your policy solution?
Sure. At this, the states will set their own requirements for both when and how wells are plugged, and decommissioning in general. There's a fair correlation, a fair pattern among them, but there is a good deal of variety, and some are weaker and some are stronger. To the extent that they are enforced and checked, it is a check performed by the regulator at the time that the plug is pumped. I know of no jurisdiction and no operator who continues to monitor the wells after the plugging.
Ted, I see you're typing an answer to this question in the chat here, but there's a question about comparing the current pace of decommissioning to the potential pace. And if the $38 billion collected over 20 years would result in the decommissioning of all shale and non-shale wells.
I think, Dwayne, stop me if I'm wrong. I think that includes all of the documented drilled unplugged wells.
Yeah.
And as Dwayne
But it's,
yeah, go ahead.
yeah, but it is a notional calculation, right? We can't start next year plugging that many wells. The infrastructure doesn't exist. The people don't exist. The point of the calculation is to demonstrate it's a meaningful, important amount of employment. Now, it would probably ramp up. It would probably ramp down at some point as it worked off the backlog. But it is going to be, in any event, a significant amount of employment.
Right. A question in the chat from David Hess, who asks, can you provide a little bit more description of how the number of future shale gas wells was calculated? And did you also do a calculation for conventional oil and gas wells?
There is a little bit of drilling going on in conventional oil and gas, in particular, a new concept in Ohio that you could see on one of my exhibits of production that goes up. But in the EIA National Reserve Report, the most recent one that's available, there are, which is compiled by a survey of major operators for their internal estimates of reserves. There's zero new drilling reserves in the proved category reported, which is not to say that it won't happen, but that it's very small. With the possible exception of this idea unfolding in Ohio. Now, when it comes to drilling new wells in the shale, it becomes a matter of predicting what the price will be and how price will develop over time, how technology will develop over time. But what we've done in the report is take several angles on the estimate, and including a third-party estimate from the oil and gas geologic literature. And we find that it's probably less than 10,000 wells that are going to be drilled in the future. Maybe it could be more, but we did not find a scenario in which it's likely that there are more wells left to be drilled than have been drilled. On a proved reserves basis, the proved reserves in the region compared to the current production in the region, which we'll call reserves life, is 15 years. And that includes drilling of proved locations.
And that comes in contrast to my understanding, right, about allusions to this idea of another 100 years of drilling in the region. Could you speak to that assumption and how why it matters in the context of establishing?
Yeah, sure. To get to the idea of 100 years, you have to rewind 13 years and contort your eyes just right. The idea came into play in 2012 when Obama was advertising this figure, and that represents technically recoverable reserves divided by current production rate. And at the time he made the announcement, the number was 102 years of technically recoverable production. But that was up, but before the start of the shale revolution, the number was 74 years. Since 2012, we have, of course, drilled and produced a lot of gas. We've also more than doubled the pace at which we produce. And today, the same measure of technically recoverable volumes per current production is back to its pre-shale number of 74. But what's more, 74 years technically recoverable is not the kind of number that you want to use as a baseline for planning. That's an absolute max. It has no regard, it assumes some changes in the future. In particular, it allows the assumption that gas price can go as high as it needs to go. The question that it answers is how much can the rock produce without regard to price? And indeed, to achieve the production that the EIA forecasts that we'll have in the next 15 and 20 years, they're also projecting an increase in price to a nominal price more than double what it has been, and a real price more than double what it has been, and a nominal price almost triple what it has been. You're muted, Ben.
Thanks, Dwayne. Apologies. We've got a question in the chat about the number of undocumented wells that exist throughout the region. Could we speak a little bit to just the need to identify the total number of wells in the region, how we're going to identify how many are out there?
It is a hard problem, and it's something that has no economic incentive. There's not any benefit to oil company to fund it. So the only way to figure out where the wells are and whether or not they're leaking is with some sort of collective governmental effort. And yeah, the numbers, especially the number of estimated number of wells that we can't locate in Pennsylvania is quite high. Ohio and Pennsylvania, Ohio and West Virginia are probably higher than, just by analogy, to Pennsylvania. but it does need someone to go out and do the work to identify it, and so that we can fix the ones that are leaking.
I was just going to add a couple of things. A recent report out just recently put the number at 340,000 or 341,000 undocumented orphan wells just in Pennsylvania. It's probably one of the best estimates we've seen in a long time. But as you know, the estimates could go up to 750,000 just in Pennsylvania, and estimates have gone up to 400,000 in West Virginia. So it's not sure, but just to give you an idea, in West Virginia, when they plugged 200 wells with the infrastructure funds and the IIJA money, they end up plugging over 50 wells that they just found on their way to plugging other wells. Just to give you an idea, it's very pervasive throughout the country. But I think, in developing the policy, we'd have to look at risk and which wells are leaking the most, which are a problem to development or getting in the way of redevelopment, which can be restored, repurposed. There's lots of factors that go into play. So that's something that an abandoned well administration, we hope, would take into consideration and use the knowledge that we know today. Because I think initially the wells that were plugged with the initial federal funds were just tried to plug a lot very fast and not really looking at specifically the ones that are worse. Now, states are different too, like Ohio, I believe through law, it has to plug the worst wells first. And that's partly why it's a little bit more expensive there too. But anyway, those can all be policy considerations that are put into play.
Yeah, and Ted, a question for all three of you really. What do you all see as next steps from this research? How do we ensure that the policy solutions outlined in this report and model legislation like the Abandoned Well Act are implemented optimally, especially given the political context right now?
I mean, I think in this moment, one thing we can look towards are the states. I know that's like a theme you keep hearing from people. But we're True Transition is about to publish a report in the next few weeks looking at platforms in state waters and proposing a state program to decommission those platforms that are no longer serving active production. There's about 800 platforms in the 3-mile nautical contour between like the state coast and the outer continental shelf where federal leasing begins. And so that's 800 platforms that we estimate that are doing nothing. And so because the state of Louisiana is executing a $50 billion state coastal master plan to restore the coast, sorry, this is coastal stuff, folks. It's an opportunity to kind of pair the orphan well and idle iron programs within that larger mission that's already public, and the state is already doing this, because oftentimes this infrastructure is in the way and has foiled coastal restoration projects. And so perhaps a state like Louisiana, which might be counterintuitive to the audience, can lead in how we can start building this this bureaucratic infrastructure that is needed to address this rusting infrastructure.
Yeah, I would just add too, other states, we talked about Ohio, they also used a portion, about 90% of their oil and gas severance tax, depending on the year and what the control board does in Ohio, but they use that, and it's lying below the year, it was about over $50 million of severance tax funds to plug wells. And even West Virginia has, used part of their oil and gas severance tax to fund wells. And that's headed in the right direction. The problem is the funds do not match the problem. And it's going to continue to grow, as Dwayne has elaborated in the report. So there are policy solutions, some at the local and state level. But I think the big point that Dwayne tried to make in the report too, that we've been talking about, is there's some places, California is a good example. Kentucky is another great example of a state with lots of orphaned and abandoned wells, but what they don't have is a lot of production. So who's going to pay to retire or decommission those wells? So that's why a national policy makes sense too, because states love to play the game of the race to the bottom on taxes and regulation. So having a national level playing field can have enormous benefits to everybody. And people aren't, the industry doesn't seem too scared about rising gas prices in terms of the exportation of liquid natural gases on consumers. So they shouldn't be too scared of 20-cent MCF fee to do this. And this is also just hugely beneficial to the industry in a lot of ways. It provides a skilled workforce. It takes away a lot of liabilities that are on balance sheets, which makes it easier to borrow. And when there are downturns, when there's no development, you have a workforce capable and ready and local that can do that work. So it's really a win-win across the board. And I do agree it's going to be difficult to get folks to see the light on that, but states are doing some of that work. It's just about optimizing it and making sure that it matches the problem that we're facing.
Thank you both. We've got just a couple minutes left today. Welcome any additional questions, and if there are any questions we don't get to today, please do feel free to send them to us via email, and we will be happy to respond. The report again is available on our website, www.ohiorivervalleyinstitute.org. I'll drop a link in the chat again here. Dwayne, is there anything you'd like to add?
Yeah, if I could just address this question about carbon
Please.
credits.
Yeah.
Carbon credits are a potentially good way to solve the worst problems quickly. But carbon credits have a limited runway because they can only be used on wells that are leaking enough that the value of the credit pays for the decommissioning. So that's going to be a small subset of the overall liability that's current right now, leaking enough to pay for the decommissioning. But what's more, it's not demonstrated yet that the charities and the companies who want to do the public good of offsetting their emissions are willing to pay for the credits that are offered. It's a potential idea, it's a worthwhile idea to solve the worst problems in short order, but it's not a large-scale solution.
We've got another question in the Q&A about the interplay between orphan well plugging and the development of the carbon storage industry in the region. Would any of you like to speak to that and just how the need to plug orphan wells as kind of a precursor for this industry?
So orphan wells and old wells in general, unplugged wells in general, represent a potential pathway for leaks. As carbon storage requires long-term monitoring and verification in order to ensure that what was bought continues to exist. There are very few wells that are suitable for injecting the kinds of high rate volumes that are required for storage. But what's more, the wells that exist and are unplugged will not meet the criteria for handling, the EPA criteria for handling non-oil and gas waste, which is to say we have to drill new wells in order to have the well integrity to dispose of the large majority of gas. So the orphan wells represent not so much an opportunity as a liability. Now, there's an exception to the extent that we have CO2 produced from oil and gas wells. It could be possible under regulations to inject it and store it with existing wells, but you still have the risk that the old unplugged wells or even the old plugged wells become pathways for leaks.
Much time. And that puts us at the top of the hour. So thank you so much for joining us today. Thank you, Ted and Dwayne, for your presentation, and Megan for joining us to share about your work. We really appreciate you all being here today to learn more about this research. And again, it's available to view and download on our website. Please do feel free to reach out to us with any additional questions, and we can answer those via email. And I'll be sure to send a link to this recording as well as our presenters' slide decks later this afternoon. So thank you again, and we hope you have a good one. Take care.
Thank you.